Hey guys, welcome to my channel Take Finance, and in this video I would be covering the topic securitization. So let's start. Starting with the introduction. Securitization is the financial process of pooling mortgage loans which generate receivables and selling their related cash flows to investors as bonds or passed through securities. So let me explain this to you in very simple way. So for example, there is a bank or any financial institution which has given loan to many borrowers. Now this loan amount together may be about 500 crores. Now the bank is in need of urgent working capital to provide further loans to the lenders. But that time the bank is lacking of fund. So it is having a way of securitization to have some liquid assets to provide to other borrowers as loan. So what bank could do is that whatever loan banks has given, it is having some kind of mortgage. So the home loans the bank has provided is having property or assets given by the borrowers as mortgage. Now these mortgage are proof and are backing the receivables which the bank would receive as EMIs of interest and principal payment over a period of time. Now, what this securitization process is, it is a process of converting all those homogeneous loans. So those loans should be of same nature and should be backed by some kind of assets, which is called mortgage or collateral. So now converting those debt or loan into marketable securities, which could be provided to the investors and money could be raised from there. Meanwhile, in that time when the bank is in need of operational fund. So in simple language, it is process of converting debt or loan into marketable securities, which is bond. And as we discussed, it is pooling of homogeneous illiquid financial asset to provide liquidity. So obviously the bank is having receivables to be received over a period of time because it has provided loan. But since the bank is just now or meanwhile in need of capital to be provided further, so that there is no hindrance in the operational activities and the business of a bank could go on. So this provides a way to convert illiquid asset into liquidity by converting the loans into marketable securities. So I will explain you this further through this simple process which will make you understand it. So suppose there are borrowers who have taken loan from bank or any financial institution. Now bank is having receivables as a proof of this repayment of loan. Now these loans are also backed by mortgage or asset which would serve as a proof of repayment. So in case if the borrowers default, these the mortgage are the property of bank or financial institution only. So these are mortgage backed loan. Now these receivables, bank is in need of urgent fund to be provided further to the lenders, further to the borrowers, and to keep the operational activities going on. So what bank would do? The bank would provide these receivables to SPVs. Now SPVs are special purpose vehicles which are created as trust. Now these SPVs convert the receivables into mortgage backed securities which are termed as bonds. These bonds are further provided to investors. Now investors, by investing into bonds, provide money which would serve as capital need of the bank, and further the money which is taken from the investors can be provided to more borrowers as loan. So this is how the whole process cycle works, and this is what securitization simply means, and it works. So I hope this video was useful for you. Thank you for watching. Do like and share my videos. Subscribe to my channel Take Finance.